Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Karen McCormick of Beringia to talk about the Proven VCTs. First off, just tell me about Beringia and also give me an introduction to yourself and your own background.
Sure. Hi, Alex. As you say, I'm Karen McCormick, Chief Investment Officer of Beringia, which manages the Proven VCTs. Beringia is a venture house that has been around for over 30 years now. We have offices in the US and the UK, and we manage the Proven VCTs from the UK office. We have about $750 million under management across the funds in total, and the Proven VCTs make up about £240 million of that.
So tell me about the Proven VCTs. What does it offer investors, and how many companies do they invest in?
Sure. So the objective of the Proven VCTs is to offer a better than market return. Ideally with a 5% targeted dividend with outsized dividends on realizations, as we've delivered on many years in the past. The Proven VCTs tend to focus on early stage growth capital companies, which I would differentiate a little bit from traditional venture in that we're looking for businesses that have proven commercial traction. For us, that generally means at least £1 million in revenue, but most of them will have quite a bit more in revenue by the time that we invest. And generally, they're either close to profitability, in profitability, or will be profitable on the next round of funding.
Okay, do you want to give me some examples of companies you've recently invested in?
Yeah, sure, of course. So we've actually had, despite COVID, we've actually had a reasonably busy 2020. So in addition to a number of follow-ons for the existing portfolio, we've invested in 4 new companies to date. And I'll also mention one that we closed on at the end of December last year. So Second Nature, which is a company that primarily focuses on health and well-being, in part through community-driven weight loss programs. We invested in at the end of last year, and that business has soared during COVID. This year, we've invested in 4 other deals that, as I mentioned. One of them is a business called Luxury Promise, which is a reseller of pre-owned luxury handbags. If you will, it's sort of a watch finder for women, for those who might be familiar with some of our older investments. We've also invested in a business called Commonplace, which is a software platform that allows community involvement in generally social sector projects. So it could be something like a new energy facility or a new housing development, and it's a platform to allow community engagement and involvement. We've also invested in a business called Social Value Portal, which effectively provides, in a way, a report card for ESG initiatives and social value delivery for companies during a bidding process. It started with involvement from local authorities who were looking to be able to validate the companies that were bidding in tender processes and understand what their social impact might be. Social Value Portal now works both with local authorities and much broader commercial sector.
You mentioned the types of companies you look for, but what's the key thing?
Yeah, over everything else, management always ends up being the key deciding factor for things that we invest in. And we're generally looking for management teams that have, generally we look for credibility. So do they understand the sector? Have they worked in it before? Do they know the ecosystem, the buyers and sellers? And can they get into doors for clients and customers? Experience. So do they have a genuine track record? And often we are approached by relatively young CEOs and founders, but we would expect and hope that they would surround themselves with more experienced individuals as well. And we can often augment those where necessary. We also look for a passion in the project that they're doing and real knowledge of the sector, an ability to tell a good story, because you need to be able to explain what you're doing, whether it's to customers or the investing world, very quickly and succinctly, and then an ability to attract and retain really top quality people. And those are usually good signs of a solid management team.
And are there any particular sectors you always go towards and anything you particularly avoid?
We are a generalist investor. The majority of our portfolio is made up of 2 sectors, which would be B2B software and then the consumer B2C sector. So those are 2 areas that we will continue to focus on, but we generally look for technology-enabled businesses.
And what about red flags, Karen?
Yes, I guess some of the red flags, specifically when it comes to management teams, would be things like defensive answers. So if it feels like we're having to struggle to get to both the good information and the bad information, and also to really get to a direct answer to questions, then we'd probably shy away from it, because it indicates that we might not be able to have the relationship that we'd like to over time with the management team. We would also probably shy away from situations in which the management team really didn't have experience in that sector across themselves. Generally, that just means it's going to be harder to open the right doors, and they're going to have to make all the mistakes for the first time. So if we did love a business and they didn't have that sort of experience, we might look to augment the team with either non-execs who were experienced or further execs within the company. But generally speaking, we would want the business to come to us with that experience around the table.
It's been a tumultuous year. How has COVID affected your portfolio?
Yes, it probably depends on what time of the year you asked us that. But I think Q1, what we saw systemically across the portfolio was really strong performance. So obviously there were some exceptions, but generally speaking, Q1 we saw the portfolio really kind of overperforming. That all turned around in March when lockdown was announced. And we, I guess, as a portfolio, we basically asked the portfolio CEOs and managers to rebudget for the year, performing rebudgeting exercise according to COVID with high, medium, and low scenarios, primarily focused on how do we conserve cash and stay alive in a worst case scenario. And I would say in the whole, the companies largely probably overcorrected. We were ready for a dire outcome, which just didn't materialize. For some of the portfolio, we're actually not only outperforming the COVID budgets, but at times outperforming our original year budget. And that's especially true on the B2C side. It has happened on the B2B side as well, but some examples would be companies like My First Years, which is a luxury children's gifting business. They're outperforming even the original year budget. MPB, which is a pre-owned high-end camera equipment business, they're performing very strongly. Business called Mix, MYCS, which sells customizable furnishings and home furniture, doing incredibly well. We also see companies in the portfolio on the B2B side, like Zuvu, which trades as Smart Assistant, which is a software to help guide customers through a shopping experience, especially for high-value or complicated products. That company is performing incredibly well. So we actually have a number of businesses that are really outperforming even the original year budget. And then there are companies like Fnatic, which is in the esports industry, where we aren't necessarily seeing huge growth in performance above the original plan, but what we're seeing is a huge amount of new viewers and newcomers to the esports industry during COVID, especially when there haven't been any other sporting events on. And so the fan base has exploded for Fnatic, and we expect to see that translate into revenue through things like sponsorship agreements in future.
And are you still getting lots of deals?
We are still getting lots of deals. It was, as I was mentioning to you before, we found over the summer, so probably June, July, August, deal flow was slow. And I think a lot of businesses who would have been raising assumed that either they wouldn't be able to raise or they wouldn't get the valuations they wanted, and therefore either did internal raises or lived on the cash that they had. At the end of August or the beginning of September, when it became clear that a lot of these companies were still continuing to perform and potentially even outperforming, we've seen really the floodgates open on deal flow. So we have almost more deal flow than we can manage, which is wonderful. Yes, and it's high quality deal flow, and we're progressing a number of deals at the moment.
So would you say now is a good time to invest?
I think now is a very good time to invest. I mean, it's deal flow is great on the one hand. There's also still a robust exit environment. And we're seeing, especially in the private equity community, quite a lot of proactive approaches to the portfolio companies. So I think it's a great time to be investing.
Why do companies come to you?
Companies tend to come to us, I think, for a couple of different reasons. One of them is just the track record. We have a very good track record that's solid, and we get a lot of referral from entrepreneurs and non-execs in the portfolio to other entrepreneurs. One of the other reasons they come to us is the U.S. presence. We have had a U.S. office and U.S. presence and boots on the ground for more than 20 years now, and we have the ability to help companies commercialize in the U.S. through adding value, anything from a desk to introductions to accountants, to helping you set up a bank account, to introducing you to more people within the ecosystem, potential clients, customers, other entrepreneurs, and other funders as well.
And you mentioned exits very briefly. Have you had exits this year?
We haven't had any exits this year, but I I think that it's still a pretty strong exit environment. So we have actually had a couple of term sheets extended to portfolio companies. Term sheets are not the same as an exit, but they do seem to be, both companies seem to be priced assets, and we've had a lot of interest, so I think we will continue to see exits.
And perhaps will then tell us about some exits you've had in the recent past then.
Yeah, sure. I mean, we've had quite a strong past 3 or 4 years in terms of exits, and we've exited a couple of businesses like, well, I'll mention Watchfinder, which was an outstanding exit for us. That was pre-owned luxury watches, which we sold, I think, about 2 years ago, and it delivered about a 9 times return for us. We also sold a business called ChargeMaster, which took advantage of the growth in electric vehicles and electric cars by providing electric car charging stations, primarily through local authorities, but also as an OEM, an equipment manufacturer. We also exited a business called Third Bridge, which does expert networks and sells primarily to clients like private equity firms, hedge funds, and consulting firms.
There must be some companies that haven't done as well because of COVID, or have done very badly, maybe.
Yeah, of course. I mean, we're relatively lucky in that we don't have many businesses at all in sectors like leisure or travel. But we have a couple of companies that have found it difficult trading through COVID. One business that I think is in a sector that's particularly hard hit. We have a business called Fest Ticket, which does what it says on the tin, more or less. It sells tickets to festivals and also travel packages around those festival events. And the business had been absolutely flying pre-COVID. And was a really strong performer. To be honest, we expected it to be a very difficult year for them, and it certainly hasn't been the easiest of times, but the management has reacted incredibly well by flexing some of the cost base where they can, things like marketing spend, taken advantage of furlough for periods that were more low season, but they've actually continued to trade pretty well, and in September just had their best day ever. Because often what happens is festivals are being sold well in advance, and especially the travel packages around them. So we do continue to trade, and revenue, while it's been variable this year, it's not nearly as poor as one might initially think, given they focus on festivals.
And there are any other trends you're seeing in the way you invest?
Yeah, I think one of the salient trends outside of technology progression in sectors is just size of investment. So a Series A round of funding is significantly larger than it was 4 or 5 years ago, and certainly a lot larger than it was, say, 10 years ago. So we see most of the Series A funding rounds that we look at today or participate in are raising somewhere usually between $5 and $15 million, which it means that we're likely to be syndicating. And often that might be with existing investors putting in up to 50% of the round, and we top off the round or lead the round with the rest of the money, or we syndicate with other private equity and venture capital firms in the industry. I think that's actually very helpful because often you can get more expertise coming from, say, 2 new high-performance investors than 1, and you've also got deeper pockets to help continue to fund the company.
Does that mean you should get higher returns at the end?
We should be getting commensurately higher returns to the check sizes. So I would expect, to some extent, the same way we've seen in the US, holding periods are getting longer, because venture and private equity firms will fund the businesses for longer. So it wouldn't surprise me if we had slightly longer holding periods and bigger check sizes and a larger proportion of our investment on a year-on-year basis going to follow-on funding. But we should definitely be getting commensurate returns to the amount of money that we're putting to work. Helpfully, what we see is that as the company is de-risked and we can follow on the money, the investment case might change. So whereas the first round of funding might have been quite a high-risk round of funding, and an example of this is what we saw with Monica Vinader, where we made multiple rounds of investment over the course of that investment. The total return was about a 6 times exit for us, but we could see that the first round of funding delivered a 12x, and then the further round of funding a 5x.
And finally, Karen, if someone wants to invest in a VCT this year, why should they choose Proven?
Yeah, I think anyone should choose Proven, largely because of the track record. We have a very consistent track record over a 20-year period. And we also have a unique position in having the US and the UK presence, where we can help sell ourselves to businesses and commercialize them more quickly with the US presence.
Karen McCormick of Proven, thank you very much.
Thank you, Alex.